equity markets, so stocks and shares, are absolutely mesmerized with AI. And tech stocks and AI stocks now account for almost half of the S&P 500, which is the combined valuation of the 500 most important listed, publicly traded on stock markets companies in America. And even though they're relatively small in number, they now account for almost half of the total valuation, up from a quarter less than 3 years ago. And some companies, their valuations are absolutely massive. So Nvidia, which obviously makes chips, is both a software and a hardware company, what we call a full stack tech company. Their chips are absolutely pivotal. Their technology is very, very important, of course. But Nvidia's market cap, their market capitalization, if you get all their shares and add them up, times them by the value, what the company's worth, it's now bigger than the GDP of Britain, bigger than the GDP of Japan, bigger than the GDP of Germany. Only 2 countries in the world, the US and China, have a GDP that's bigger than the value of one company. Now, I'm not saying that, and there are other companies like that with monstrous valuations. I'm not saying AI is not important. I'm not a Luddite about these things at all. But the market is priced as if all these companies, a bit like the dot-com boom, just because they had a .com in their name and the CEO wore a T-shirt, suddenly they had massive multiples. What does that mean, massive multiples? The value of the company, as judged by the stock market, divided by the average earnings, the annual earnings, right? And often a PE, the long-term historic average of the S&P 500 is a multiple of 17. So a company is worth 17 times its current annual earnings, which kind of makes sense, right? If somebody builds a small company and sells it, they might hope to sell the company for a multiple of 2 or 5. But if you're a big listed company, obviously you've got a massive culture, a massive brand, systems. They've built up over many years in most cases, a multiple of 17. Well, if you get the combined all the multiples of all the companies in the S&P, the composite multiple of the S&P 500, as measured by something called the Cape-Shiller index, which is the cyclically adjusted price earnings multiple composite, and it was an index very influential index, founded by, among others, a professor from Yale called Robert Shiller, who's done very well for himself, but rightly so. It's a very interesting composite index. Just before the global financial crisis, the Cape-Shiller got up to 28. So the average company was worth 28 times its annual earnings, which is a lot. So in other words, shares are really, really expensive. So they're gunning for a fall. There's a lot of hype. A lot of people are borrowing to invest in those shares. That's called leverage. When you borrow money to invest in shares, or you borrow to do an investment, it's called a leveraged investment. The cyclically adjusted price earnings ratio, cyclically adjusted means you take out like the booms and the busts. You're trying to get a sort of common smooth path. We're now well above 40, which is well into .com territory. And I think that's the biggest danger. The fact that equity markets, these stocks are being massively hyped and hyped and hyped. And I'm not saying AI isn't important, but a lot of these companies are going to fail. A lot of these companies aren't going to work out. History doesn't happen in a straight line, as I said in the column. AI is really controversial. That's a statement of fact. I'm not arguing that it's wrong. I'm just saying the reality is, somebody that does economics and finance but does politics too. A lot of politicians are going to try and stop this because a lot of people are worried that their kids can't get a job. The regulation is going to come. Often, a lot of these AI companies, they're not factoring in the reality that the data centers, the chip plants that drive all this stuff need massive amounts of electricity. And a lot of Western countries, particularly our country, won't have the electricity, right? It's going to take time. So a lot of the companies are going to fail because they're just going to consolidate, be overtaken. You won't always have the electricity. the regulation will stymie a lot of sort of commercial visions, and kind of rightly so. I mean, it's a bargain, right? Everything's a bargain. So you got those three things happening, which means the fact that the market is priced for perfection, because everybody's assuming it's just going to go to the moon forever, because I think a lot of people in finance, geopolitics over here, sovereign bond crisis over here, they're going, la, 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 AI, 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 keep investing, keep investing, keep investing. I want my bonus, I want my bonus. I've got to build a conservatory, I've got to pay the school fees, right? That's what's happening. And then on top of all that's known, right? That's all that is kind of out there. That sense is out there. You can hear that at any investment conference. Someone will stand up and say electricity, and someone else will stand up and say, my kid can't get a job. But the new thing, not new, but an idea that isn't out there, is what I wrote about on Sunday and in the Telegraph, and maybe you can put the link in the show notes to your episode, is this. What we're seeing is massive multi-billion-dollar investment in AI, right? In all the data centers. They're really expensive. The chips are really expensive that you need. Now, you had a massive boom in the 19th century on both sides of the Atlantic in the railways, right? And it was an investment mania. You had massive investment in the dot-com boom with, lots and lots of fiber optic cable was laid in the ground. That was very, very expensive. The cable was expensive, glass cables encased in plastic, got bury them under sensitive parts of the town, cities, long distances. So the railway boom and the dot-com boom, they've, fostered the railways and the internet, which, two massive industrial revolutions, two completely transformational things. What's happening with AI, the fifth industrial revolution, if you want to know what the other four were, you can read my column. The fifth industrial revolution, it will be transformational. That means that massive investment is going on to reap the benefits of that transformation. Both the railway boom and the dot-com boom, the massive investment that you had in the infrastructure was driven by leverage, by people borrowing to invest. This AI boom is the massive investment in the data centers is driven by leverage. And how? Absolutely huge amounts of borrowings going on, a lot of it from so-called shadow banks. So these are basically hedge funds pretending to be banks. That doesn't mean that you're going to see a branch on the high street anytime soon, or they're going to give you a loan to start your plumbing company. No, they're just lending big money to AI developers. And it's almost completely unregulated, right? So the risks that are being taken are huge. Now, any kind of, with very minimal regulatory oversight. So what's the difference between the railway revolution, the dot-com boom on the one hand, and this? The leverage, the loans in the railway revolution and the dot-com boom were collateralized, often, largely in some cases, on the infrastructure that was being created, right? So, okay, if my company goes bust, my creditors, own the infrastructure. And the railway lines were in the ground. All the digging had been done. All the rolling stock was there. The stations have been built. And in the internet revolution, the fiber optic cable was in the ground. It's still really, really valuable. And in both cases, Brendan, that infrastructure was there, remained valuable, and had economic use and worth. I mean, the railway lines are still being used. The fiber optic cable is what's that was laid in the dot-com boom with massive overinvestment and massive mania, is what is now facilitating these data centers, right? So the loans were collateralized against infrastructure that was being built that had demonstrable, ongoing, sustainable value, whoever owned it, right? So the loans could be transferred, they could be refinanced. Obviously you have to take risks. Obviously, when technology is at a cutting edge, the risks need to be taken quickly, and people of, without the cojones to do it need to get out of the way, right? That is what human progress is about. Yeah. But this boom, and of course, the railways and the internet, even though they were both massively important, there were manias, panics, and crashes linked to both, even though the technology was obviously important. No one's saying the technology wasn't important then. No one's saying AI isn't important. You can't dismiss what I'm saying by trying to convince me, by trying to present me as some kind of Luddite that doesn't understand. So here's the thing: the collateral for these AI investments are the chips that are being used, and the chips, by definition, have a very short lifespan because they're constantly being outmoded by better chips. So if you are collateralizing your loans on the NVIDIA chips that you're buying with those loans to build your data centers, and the NVIDIA chips, you're putting in your nice spreadsheet that convince you and your investors that you're all going to get rich. You're saying, oh, these chips will be around for at least 5 or 10 years. But actually, what's happening in the real world is these chips are being outmoded after 1 or 2 years. The collateral you're holding, you got a warehouse full of Walkmans in the age of the iPod, to bring it back to our generation. Now, people who I really, really respect in the AI world, I talk to lots of serious AI entrepreneurs. Some of them are my good friends. So it's not personal. They're saying, yeah, but the chips will still be valuable. I'm like, but how valuable? And they'll be increasingly less valuable. And if you're collateralizing a loan that's looking increasingly marginal as the other things happen, like the electricity isn't there, the politicians go nuts and try and ban it, or try and rein it in, or all the other stuff, then your loans, look less likely to be paid back, and your collateral is depreciating. Houston, we have a problem. And that is why it's a long explanation, but I really think this is important. We've got to get this idea in the thick skulls of our political and media class. Lots of them, there are exceptions, don't at me. Unless we get hold of this and realize that, yes, AI is important, but we are now deep into bubble territory with a Case-Shiller index above 40, with stock markets at record highs despite, carnage in geopolitics, carnage on Western country sovereign balance sheets, including some very big countries. We're not talking Greece and Thailand. We're talking the UK, we're talking France, big countries. So I think we are facing multiple dangers to financial stability. I think the prices of equities have completely lost touch with any kind of reality when it comes to the underlying economics and politics of the actual, and geopolitics of the actual world. And remember the late Queen, genius that she was rhetorically. I think, I mean, what better phrase is there than recollections may vary? Bracket, she's a lying bastard. Yeah, but the late Queen, when she came to the LSE, and I was there during the visit, got close associations with the LSE, and she said, why didn't anyone see this coming after the global financial crisis? Well, some of us do see these things. There were journalists like me that were warning about massive buildup of synthetic debt in housing markets in 2005, 6, and 7. There are people like me now saying this, not many, because people that have looked at it as closely as we have, they're too busy making money and they don't want the party to stop. And there has to come a point where people who move in these circles, who can see these things, you have to just say what you see. And of course I'll be lampooned. I'm getting mullered on social media because of this, because of the column I wrote on Sunday. Why? Because I'm threatening people's hopes and dreams. And there's an awful lot of people trying to make serious money out of this stuff and just keep hyping the stocks up. But meanwhile, there's a silent majority out there that's, tens of thousands of times bigger, of ordinary people who are going to get absolutely walloped as and when there's another, serious bout of financial instability. And we're making a habit of this, Brendan, our generation, the dot-com collapse at the end of the 90s, obviously the biggest financial collapse since the Great Depression in 2007. The Eurozone almost destroying itself and the rest of the world in 2010-11. We don't hear much about that in the FT and the Economist these days, as they're banging the drum to try and get us into the single currency, back into the European Union. Then, of course, the massive policy error that was lockdown. I'm not saying COVID wasn't important. Of course it was. But should we have locked down the kids? Really? Really? I don't think so. So we're at a situation where I think if there's another massive financial crisis, a lot of ordinary people at a time when democracy is fragile and political leaders in democracies are increasingly making fools of themselves, and the rise of political violence, even in democracies, is clear for everybody to see, then I think another big financial collapse at a time when governments across the Western world haven't got the fiscal firepower like they had in 2008, because they're indebted to their gills, because they printed hundreds of billions of dollars, pounds and euros of, funny money. I think this is a serious situation, and, shoot me down, but some people have to say what they think is going on. And I wish I had a quid, Brendan, for every prominent person who's WhatsApped or emailed me and said, you're right, keep going. And I'm like, well, retweet it then.